people often think when people start, they have this like master plan to have 200 plus investors and they're buying buildings across the country. I don't know if me and my husband had that plan, to be honest. We were always committed and really, really in the business of how do we take care? How do we make people money? How do we get into the right projects? How do we do this for the long term?
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, now offering a $250 per unit project allowance to new clients in West Michigan. Find out more at livegreenlocal.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 319. Today's guest has learned many lessons while scaling her rental portfolio to $60 million. She's also going to talk about raising private money with confidence. Liz Faircloth co-founded the DeRosa Group in 2005 with her husband, and they control $60 million in residential and commercial assets up and down the East Coast. Her mission is to transform lives through real estate. Along with our previous guest, Andresa Guidelli, Liz is the co-founder and CEO of the Real Estate InvestHER community, co-host of the Real Estate InvestHER Show, which is part of the Bigger Pockets network, and co-author of The Only Woman in the Room, Knowledge and Inspiration from 20 Women Real Estate Investors. Liz, welcome to the show.
Brian, thank you so much for having me. It's a pleasure.
Pleasure to have you on the show as well. Why don't you fill us in on your background, how you got started investing in real estate?
Been around a little bit, in terms of time. My husband and I actually started investing together when we were dating about 16 years ago. And we didn't know anything about real estate investing. Neither of us had even entrepreneurs in our families. We both came from very hardworking families. We came together, and my brother-in-law handed me at the time, Rich Dad, Poor Dad. And like so many people, I was on this trajectory to be a therapist. I was in graduate school learning I got my master's degree in social work. My husband was an engineer at the time. He had an engineering job. So we both were on two very different trajectories of what we wanted to do with our lives. So reading that book when I was about to graduate from grad school, and I at the same time met my husband now, it opened my eyes. I was like, wow, these are things I've never even thought about or even had in the realm of like possibilities, right? Passive income and property. And I'm like, wow, there's a whole new world here. So, then you start to like, just want to get more information. And at the time, my like I said, Matt, his name is, at the time we started going to all the RIA meetings. There was a local RIA group, DIG, still in operation, great organization outside of Philadelphia. And we started just attending the meetings. And for a year, we studied and learned and went to every seminar we possibly could do. Like when we got together, I was living in New Jersey. He was living in Philadelphia. That's what we did. We were in our 20s, right? That's what we did on our weekends. It's really exciting stuff. But that's what we wanted to do. We wanted to really get into this business, and something about the financial freedom, and then just the asset class of real estate, of really being able to touch it and see it and make it better and transform it, really intrigued us. And it was really like, we could really create something magical here, hopefully. But so that was the goal. And then we bought our first duplex in 2004. And right outside of Philadelphia. And my father loaned us the money at the time, $30,000, and that took care of the down money. And down money was around 15 at the time. And the renovations was around the same, 15,000. So that took care of us getting in. And that was our first deal and our first private money deal too, because we didn't have the money to buy it. And that kind of just started our journey, I'll say, because it was a journey. It didn't just like go from there and then buying all these apartment buildings and then we're good. That definitely didn't happen for our story, if you will. But that's when we got our start. And then that gave us the first kind of taste of getting in and renovating and dealing with tenants we had to evict and all the things that come along with owning property.
You're starting with that first duplex you and your now husband acquired. How long did it take you to actually start building momentum to where you're now today at a $60 million portfolio?
You can argue that the whole 16 years was momentum, or you can argue that there was some twists and turns. And then once we got very focused on growing our multifamily with private money, that's really when our business probably took off. So I'd probably go to the latter, in terms of just the strategy. So from 2005, when my husband so 2004 is when we bought that duplex. And then we decided to kind of focus on New Jersey. And we focused on the market of Trenton, New Jersey in particular. We got married in 2005, moved to New Jersey together, and then decided to create our portfolio from there. Well, in the next, I'm going to condense these, but in the next probably 5 years, you had a market crash in there. I quit my job. There was a lot that happened in that 5 years. And we were all over the place. We were in multifamily. We had some fourplexes. We were flipping property on the side. So we had a construction team that we actually started even after 2010. And then we had a commercial building. So Brian, we were a little bit all over the place. So our momentum wasn't this like, get focused and then go all in and scale. That didn't happen for us. So it wasn't until we started to really look at where are we having success and then where are we not. And we really got very honest to say, multifamily is what we got started with. Multifamily is like our bread and butter. When we buy right and create the value, and it's the classic BRRRR strategy, it works. And you're in the right market with the right team and everything lines up. We couldn't always say that with every other investment we were doing, or investment strategy, I should say, that we were doing. Flips, some of them were wins for us because we partner with people, and other flipping is not, it's a business, and it's not the most forgiving business, especially if you get into projects that you're not managing timeline, you're not managing budget. So regardless, I think it was around 2010, I ended up going back to the previous work I was doing, and we really, really focused. And that's when we started to build with other people and really hone in on other private money partners to equity partners, I should say, to start buying bigger buildings, not just the duplexes, the fourplexes. So then went from like a 10 unit to an 18 unit to a 49 unit. And then that kind of grew from there. It was a moment in our business, Brian, we had to like say, what's working, what's not, where are we having success, where are we not, and start to get very refined with our own business plan and our own focus. We were younger, we were a little more naive. I don't know if we were like these seasoned business owners when we went into this. So would that look differently had I started it now? I don't know. I'm not sure, but I always say we grew up in this business and we kind of grew our business from scratch without much knowledge and experience, but with just this persistency that we didn't give up. And that's quite honestly how we've been able to scale. Once we got focused, it got easier because then the team, you're starting to build off the team. And our growth in the last 3 years was more than we grew probably in the first decade, right? In terms of unit count. Because then it's just now you're just adding buildings and scale where it's so much harder at the beginning, Could you be a little more specific about that early on? A lot of the things that you were doing, some were working, some weren't. Tell us more specifically what wasn't working and why. So we had a number of properties we were managing ourselves. So we were self-managing up until probably 2013, we were self-managing our portfolio, which is quite close to 150 to 200 units. So, that was working from the perspective of, we had an in-house team, we had a leasing agent, we had a whole team, tenant relations person, someone doing our accounting. And that was working from the perspective of us managing that, us managing the properties, us managing the deal, finding the deals, managing the renovations. We had a team. So what wasn't working from the perspective of like getting just distracted with other ventures, other strategies, if you will, like I was saying, flipping. We were flipping a handful of properties a year, but when you have multiple strategies, exit strategies, if you will, in this business going on at the same time, that can work if you have like successful people leading them and you have successful processes in place. So we were just building our processes really for managing our own properties, building a team, working with private money. So that was building and that was working. But I don't want to say distractions, but I think having your hand in too many, we had raw land. We were working on a raw land project. So our hands were in like 3 or 4 different niches. And I think there's nothing wrong with that. I think though, when you do that, you should have mastered something and have the right team in place, the right process in place. Then you can kind of like get diverged. That happens all the time with serial entrepreneurs or people that have started something and they put the right processes in place. I think we were doing that, but we were in the process of doing it. So I think we got into new things too quickly. And maybe it's part of our personalities. And you can make the long list of why that is, Brian, but I think we got too focused on multiple strategies. And I think that in and of itself diluted our growth early on with multifamily.
When you looked at multifamily, you realized that was what was working, and that's what you should really kind of focus your energy on. What was it about the multifamily that was working that made it so apparent to you that that's where you should focus your energy?
Rentals are very forgiving. I mean, you can even buy a property for too much money. Not that anyone wants to do that. But, if you're going to hold it, you're going to improve it, if it's in the right area, over time, right, you're paying down the mortgage. So other kind of strategies like I said, flips are not as forgiving. You buy a property and you overpay for it and the construction goes over, you have to sell it. And you can rent it, but it's still, you know what I mean? Like there's not like this long-term play. Rentals are long-term and multifamily can be very long-term. Now, as you grow and you syndicate, the timeline of that is going to compress. However, early on, rentals are kind of more forgiving in that sense. We also then really looked at, okay, where do we have the team in place? We had a strong team for our rental properties, which was managing all the properties we were, finding and getting opportunities for. We had built relationships with brokers who were, finding those deals for us. Every other niche that we were in always seemed to be not a struggle, but we were always trying to find the right team. We were always tweaking the team. We were always kind of tweaking the process. And that happens. That's going to happen all the time. And you always should be tweaking and making things better. But it didn't, we had the strong foundation for multifamily, plus then just the obvious return of multifamily when you're in a classic value add opportunity, right? You're adding the value. You're adding the value to these properties. So if you're buying right, adding the value, you can do very well. And then you're refinancing. And we were able to refinance, our first private money deal with someone that wasn't in our family was 2 single family homes. We bought them for $58,000. These two, almost in a sense, a duplex. And he put the money up. We were the sweat equity. So we had the construction people ready to go. We had the relationship with the local bank that we were going to refinance for. So we had everything lined up. We were tapped financially. So that was a great kind of one of our first private money kind of equity partners. And it was 2 single family homes. This wasn't a large apartment complex. So we did that. We did that multiple times. And that was wow, you can buy a property, undervalue, renovate it, refinance it, pull all of your money out, and the money's still cash flowing and making money for you. And it's an infinite return, right? So the light bulb goes on of the infiniteness of real estate if you're doing it right, buying it at the right price and everything like that. So that seems like a great project to do more of, and that's kind of what we really went all in on in terms of multifamily with equity partners.
How were you structuring the deals with those equity partners early on? And how did that change once you discovered private money?
It's interesting because so many people, I think of they think of getting private lenders, right? They're looking for lenders. They're looking for people to lend them money on a project. You can do that when you're doing certain BRRRR strategies or a classic, but you need to buy it low enough so then you can pay out your lender, obviously, and make them whole. We really liked the strategy, and not everyone does, because equity means that you're partners with people, right? So that opens a whole other can of worms, right? This is not you're lending me money, there's a transaction, not that you shouldn't vet that person, but it's a short-term, arrangement, if you will. With equity partners, you're in it for the long term, right? You're literally starting an LLC with them, or you should be starting an LLC with them. So many investors that are scaling and looking for private money really shy away from equity. They get very nervous about it, or they think they have to syndicate. There's nothing in the middle, or that's not necessarily true. We were working with private money and equity partners a few years before we did our first syndication. So way we structured it with one of our first investors there, we did 50-50 partnership on the LLC. The LLC owned the property. And you always, each LLC owned its own property, if you will. So you're obviously focused on different owners, and owners can't, own a bunch of different buildings together if they're not all the same type of owners. So it made it simple, right? To just create an LLC, buy these 2 single family homes together. and you go in as 50-50 partners. Now, we're both active partners, not to get into too much detail. I know my husband talks about this a lot in his book, but you have to be really careful of, like with equity partners, that you're not breaking any SEC rules. So the key there is that we were both active. And that is the key when you have equity partners in that realm, meaning we had roles. He didn't just put money in. He had other roles. We had weekly calls. He personally guaranteed the loan. He was a high paid employee. So that was great for us. We were not. That was a value to that bank who was lending to us when we refinanced. We didn't have as much to show at that time to say, hey, we're self-employed. Monthly, he audited the books. So we both had active role in the company, which is totally fine when you have equity partners. If he was literally just passive, technically, from an SEC perspective, we should have syndicated that. Now, why would you syndicate a property you're buying for $50,000? I mean, wow, that's complicated. That's way too much complication for such a small deal, right? But that's what so many people do, and they don't know what they can and can't do. So that was active. When we transitioned to the first deal we did, one of our first projects was an 18 unit, where it was one of our first syndications. We had 7 investors involved. They were all passive. They're so completely different, right? We filed with the SEC. It was a syndication. These folks were passive. They didn't come and audit books or do this, do that. They literally invested money in the deal. They were limited partners. We were general partners. Started an LLC together and went down that path. So those are the kinds of things that you have to be really mindful of, right? And making sure you're doing things correctly. But we didn't start syndication with our number of our first private equity partners. And you don't have to, as long as you're doing it the right way.
Anyone who listens to this show knows that Green Property Management manages my entire West Michigan residential portfolio. They manage single families all the way up to large apartment complexes. Marty and his team are running a new special that I think is absolutely nuts. And I tried to tell him so, but he wouldn't listen to me. They want to offer new clients a $250 per unit project allowance to have their in-house licensed crew tackle any project, big or small, for new clients. I can tell you from personal experience that their unique management style will save you money, eliminate headaches, and increase your net operating income. You add on top of that this limited time offer of $250 per unit for new clients, and it really becomes a no-brainer. So text GREEN250 to 21000 or visit them on the web at livegreenlocal.com and tell Marty I think he's gone off the deep end with this absolutely nuts $250 offer. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. So is that how you're raising your equity now, through syndication? Okay, so when you talk about private money as it applies to you now, it's really syndicating using private investors.
Yeah, and since that 18 unit, and then we actually bought a 10 unit and then a number of other units, that kind of propelled, and that's why people syndicate, right? They're getting into larger buildings that, the numbers just on their own, they're going to need to pool money together. That's like syndication people get a little sometimes like overwhelmed of what it even means. You're pulling money together to buy an asset in a simplistic way. And then you're able to really, give them the returns that your goal is, and add value to the property and execute your business plan, whatever that business plan is, and make everyone money. That's the key, both on cash flow and when you sell the property. So that's that is the structure now. That and typically everyone's a little different, but you'll see a lot of GPs keep about 30% of the partnership, and then limited partners typically get 70%. Now, there's a lot of interesting strategies, even ones that we've looked at. Some of these buildings, some syndicators, 5 to 7 years are in and they're out, or even less right now because the market's so crazy hot. However, there are some of those properties. There's a property in Pennsylvania that we're just like, it's a syndication, but it's just one of those buildings we don't want to ever sell, to be perfectly frank. And for a lot of different reasons, so you can have the strategy of refinancing where you start to say, okay, certain investors want out. Maybe they want their capital to do other things with. So we actually just refinance that building. And a few investors decided to go down the buyout route. So we owned a little more of the building. So again, there's always ways to kind of structure things that are win-wins for everyone, because not everyone wants to be in a project a long time. But again, it's all listed in your operating agreement. You have to adhere to your operating agreement and have a really good attorney helping navigate that, so you're doing the right thing by not just your investors, but for yourself.
So let's talk about syndication. And you talked about the investor timeline. Just like you, I syndicate. That investor timeline has been an interesting conundrum for us because some investors do want it in and out within 3 to 5 years. But what I found is a lot of my longer term investors, they want to stay in as long as possible. They like getting that cash flow and just having that come in. So what I just heard you say is that you structured some of your syndications so that you have that option and that flexibility to buy out, or I don't know if you consider it a buyout, but to get some of your investors out while keeping others in. Can you go into a little bit more detail on that? Like if some investors when you do a cash out refinance, if some are going to exit and some are going to stay in, how would you structure that?
I wasn't as part of the interworkings of the whole refinance, so I don't know if I can give you a tremendous amount of detail. But in essence, what you're doing, and I see a lot of other syndicators doing this, is saying, what's the long-term play here with this building? And, sometimes you don't know that, obviously everything changes, but having that awareness from the beginning, I think is helpful. And just from a philosophical perspective, kind of like, okay, what's the plan here? And what's the hold here? And then laying out, in essence, when this particular project, when we bought it, when we purchased it was probably 26 years ago. So 2015 was when we bought this 50 unit in Pennsylvania. We have about 9 investors or so in that building or so. I'd say 8 or 9 investors. That's a different conversation, especially if you've laid out in the operating agreement, talking about what happens in a refinance and what are people's shares worth, all those sort of things. That's an easier conversation to have with those 9 investors than say, we had a 336 unit we just closed on a year ago. We have, I don't know, I want to say close to 60 or 70 investors. Whole different ballgame, right? So with the smaller syndications, I think it's probably easier in some ways with the smaller syndications. But that building really had the opportunity to really because you have to go to those investors, right? Whatever is laid out in your operating agreement and whatever you could do legally, there's still a process that you have to follow. And that's kind of what I think it was laid out in the operating agreement of, in a time of a refinance, the investor has these options. And so you're really listing out those options. They can either stay in for X percent or X, return, or they take their principal back plus a XYZ interest rate. I don't know the specifics for this particular, project in terms of what we gave them, but I do know that it has to be clearly laid out. And what I do know is that, it could get very sticky when it's not, and people don't feel like you're going off of black and white, what's on the paper. And it's very clearly stated out. So I will say that because, sometimes people have amnesia and don't remember certain things and, all those, how that goes. So it's okay, what does the agreement say, but you can lay that out. And I think those type of legacy properties are the ones you would probably, most likely do that with. And ones that are adding every building, I feel like is going up in value, but this building, we're building another 40 units. So we're going to literally double our unit count. And we knew that was going to happen in the time frame, but that happened 6 years later when we had a very strong asset already. So again, you're kind of playing out every circumstance and who wants to, stay in, who doesn't. And again, as long as it's in writing and you're following that, calling each person, the process is laid out. I'm almost certain where you have to call an investor, send them, a certain amount of agreement. I don't know what exactly it's called. I'm sorry, but I know, and our attorneys are very involved in it too.
It's amazing how when you syndicate, you really have to think all the way through, not just from acquisition and raising the money and closing, but what happens when you do sell or there's a liquidation event like a cash out refinance, a sale. In your case, it sounds like you're going to take some of that money 6 years later and build more buildings on the property. So you need to allow yourself that flexibility to make the best decision possible when that time comes, because there's no way to know 4 years out what the economic conditions are going to be. So I love what you're saying about that flexibility. How would you compare your early syndicating to the way you syndicate now? What are some of the lessons you've learned and the things you do take into account when raising private money and syndicating now?
Just from a sheer scale, right? We have over 200 investors we work with now, right? And when we started, the processes that we had in place, like we had a spreadsheet of, each amount of money. I mean, you had 5 investors, you have 5 private equity partners. Do you need like this robust system online? I mean, some people might say, yeah, build it and you never know what will happen. But I think when we started, people often think when people start, they have this like master plan to have 200 plus investors and they're buying buildings across the country. I don't know if me and my husband had that plan, to be honest. We were always committed and really, really in the business of how do we make people money? How do we get into the right projects? How do we do this for the long term? And this is the right model for us, right? Buying larger buildings with a lot of people. The systems and processes and the teams just completely evolved in a really good way. So, I was doing all of our investor relations for many years. We have a great person now that's doing that. As my other professional kind of endeavors took off, I couldn't do that any longer. And I really loved that kind of front of connecting with our investors. Same with Matt. But it gets harder when you have so many people, right? It's just more of a scale. So our systems, we upgraded our systems. So we have like more of like a portal now where there's more of like a user-friendly, they can see how much money they have invested with us, which deals they're in, all those sort of things. When we got started, we would just send email updates. Like, hey, this is what's going on at the property. You always want to update your investors monthly. What's going on at the property? Are you at stabilization? Where are you in terms of stabilization? Pictures of the property. People, that's the biggest complaint investors have, right? Private money partners have is just that they're not updated enough. And we always did that. Now, how we do it has evolved, right? So we used to send emails, once a month. And we do send emails still, but we do it through more of like our portal where they're getting like, photos and videos. And it's a little more of a streamlined system, right? We're not just literally going into Google Gmail and putting everyone's emails because there's only like 6 people's emails. Now it's a different ballgame. So you're doing it in a more of like a structured active campaign and all those systems out there where you're doing it more robust and you can send out that seems like a simple thing, Brian, but when we started, that was something we had to evolve to where what's the system that's managing investors? And then who are the people who's managing that system? Even during tax time, think about all the things you have to do when you're right around January, right? K1s are coming out. When we had like 5 or 6 investors, right? It was like, I emailed each person their K1 and, hey, hope your holidays are going great. And you have these personal connections with people, but then as you scale, it's really hard literally to send one email. That's 200 emails, literally. Obviously, that would be like, someone like, ooh, you got to check your brain if you're still doing that. So how do you do that on a scale, but also make it personal? I think that's been hard because scaling naturally, right? There's a little more impersonalization. But what I can tell you is that something we've offered and something we've done to create that connection with our investors is we have a membership called DeRosa Insiders. It's a Facebook group and we do a bunch of content there, but it's really free for our investors. So people can pay, or if you're an investor and you invested money with us, it's for free. The point of that is to also go above and beyond. This is you're not just making money on your investment with us, but you're going to learn. So many people want to learn so they can be more active as well. Some passive want to be active want to be passive and vice versa. So we've done those kinds of things that we didn't do early on. So I think we've evolved and we've streamlined, but we try to think about, we give gifts every year to all of our investors. We used to do that. We still do that. Has the gift shifted in how we send it out? Yeah. And it's hard to send personal thank yous, but it's important that people feel appreciated and they're our customer and they're our lifeline. They're our lifeblood and we want to take good care of them. And we're evolving on how to do that. But those are just some thoughts there in terms of how we've scaled our systems and processes and team, because you just can't do it by yourself.
What are some of the tools then that you're using to scale? I mean, you mentioned the portal, CRM software, and then I have to ask you, what kind of gifts do you send to your investors as well? Because that's an interesting idea.
The program is called Invest Next. There's a lot of these portals out there, but that's the one we've used actually a couple, and that's the one we've settled on. I think it's Invest Next. And really, it's like a CRM for investors. It's the easiest way to think of it and to say it. It connects with QuickBooks. So all of our QuickBooks and financial reportings do connect with it, I'm pretty sure. So that's all kind of streamlined as well, because you're sending out reports, right? And you have to make sure you're sending out, the appropriate ones for the month before and all those sort of things, because we do monthly updates. We use ActiveCampaign for email communications and to connect with Invest Next in a sense. So the other systems, obviously, like, the Google Drive and making sure folders and all those, everything's in the cloud and obviously what most people do. But all the investors' important information is in Invest Next, which is a lot of, very important information you don't want anyone to just get a hold of. Clearly, these are really private, not just Social Security number, but, these are that being mostly critical. And then their subscription agreement and all the paperwork they sign with us, right? To get involved in these projects, all the legal paperwork. So it's all kind of stored in the same place, which is great for them, great for us, and it's, very protected as well. But yeah, in terms of gifts, we used to even just mail a book of the year. So we chose a book that we really liked, something simple. Even last year, we didn't do a book. We actually did a mug with our logo on it, a nice coffee mug to each and every investor. That was an undertaking. I want to say we've done planners with our logo on it, but it's when you scale, it's like, okay, I know for me and the InvestHER side of it, we're thanking people and thinking about thanking people in terms of gifts. And I'm like, okay, so as you scale, right, $10 is not a lot of money, but your times you get by 100 people or 200 people, you have to think about that in that term too. So, but it's an investment and you're thanking people and it goes a long way. And these are all investments. It's not a cost. It's not, yes, it's an expense, but I always see appreciating people and thanking them as something that we all don't get enough of, but yet people want it. And they want it because they have a lot to choose from. They have a lot of people to invest with.
As we wrap it up here, any other advice you would have for our listeners on scaling their portfolio and or syndicating and raising money for private investors?
Process and people. And, and often we realized in so many ways, Brian, that me and my husband were both probably more on the visionary scale. Like I would highly recommend anyone listening to this to read two books. One, Rocket Fuel, by the gentleman who wrote the book on traction. It's his second book, but quite honestly, I think it's the best one he wrote because it really goes into depth of takes a scale. Like, are you a visionary? Are you an integrator? Because as visionaries, you're not naturally going to think about building. My point in saying that is you're not naturally going to think about just process and people. You're going to be thinking about new ideas, new markets, new. And that's why it probably took us so long to scale our business, to be perfectly frank. And you need that integrator. It's called an integrator, a visionary and integrator. And the integrator is really thinking about the how. And now, as we've grown, I wish we knew that earlier on. We would have thought about how do we partner with someone who's an integrator? We partner with someone who can put the processes in place. We figured it out because we stumbled through it, to be honest, and it took us a long time. But I in hindsight, would have been really, okay, here's what our strengths are, which we knew subconsciously, but to really put it in practice, right? Another great book is by Dan Sullivan, where he goes through, are you a multiplier? Are you a simplifier? I'm a big fan of personality assessments. So if you took a personality assessment, figured out if you're a multiplier or a simplifier, and if you're a visionary or an integrator, and you put these three pieces together, I feel like which we just did in the last couple of years, or even for my own, you start to say, who do you really need to complement the team? Because it's a team sport. So, but bottom line, you need the right processes, you need the right systems, it needs to be documented, and it needs to be in a place that like people can follow. If you get hit by a bus, is a standard operating procedure. It's not something I naturally do, Brian, but I'm so appreciative of them because they help you like, what do we do in this situation? And that's so important. But I'm not someone who's going to write an SOP, but I appreciate it. And we have people with us that can and do, because that's the way they think, versus beating yourself up and trying to stumble through a process that you just don't want to create. Well, find someone to help you do that. People just throw people in places and think like partners and people are going to solve it all. But if there's no process and there's no foundation, the right person will come and go. They just didn't have the right process to follow. So I'm all about those two things now, but I don't know if we always have been, but that's, you learn and grow and figure it out.
What's your biggest challenge right now? Where you are with your portfolio, with your business? What is the biggest challenge you're facing at the moment?
I'm spending probably the majority of my time. I'm active in our business. I have a seat on our team. But in terms like the day-to-day, my husband runs that. And I've been spending majority of my time on growing our InvestHER community, which is a women's, community, helping women empower them to live a financially free and balanced life. So as I grow as a leader there, we're building out a team, and same kind of thing. We're building out processes and a team. And, when you're growing, you have revenue coming in, and then you say, okay, what can we afford in terms of people versus where's the investment, right? So that's where I am mentally of saying, and I was just on an entrepreneur podcast and I was being interviewed, and she said something really great. She's like, never look at a team member as an expense, look at it as an investment, just like you would as a real estate. And that light bulb went on for me. Not that I saw it only as an expense, but I think I was leaning probably on the expense side. Well, not until this. And so that's where we are as we grow our own community and we're building our own staff to help us build out what we're up to. Great mindfulness of entrepreneurs, of investing in people versus looking at it as this is going to cost me this. Well, what's it going to give you? So that's kind of where my own evolution is right now in terms of really growing the team, because we have a number of folks we work with, but it just increases as you grow your team,
Tell our listeners a little bit about the InvestHER community. What's the vision and how exactly are you living that out? I mean, what does it mean to be part of the InvestHER community?
So a few years back when I was we were doing a handful of projects together, me and my partner, Andresa, we were partnered with her and her husband, me and my husband, and they were in Philadelphia, we were in New Jersey, and we were flipping a number of properties together and doing some projects. And over that time, her and I would get together and talk about the project or talk about something there. And then we would just kind of look at each other and go, where are the other women in this business? We love working with men. They're great, but there's something about, kind of getting women together and having them support each other and holding each other accountable and giving each other the mentorship that one another needs. And we kind of Googled it and looked for it. And there was nothing there or nothing we can find at the time. And so we said, why don't we start with a podcast where we interview just women and shine the light on their greatness and their journey. So it opens the door and opens the light bulb for women everywhere where, wow, I'm seeing all these women doing this. Because we would be told you're going to not have enough women to interview. There's not a lot of women investors. They're just not out there. And that's been the furthest from the truth. There's tons of women investors and more. But what we're trying to shift is not just the stereotypes, but just how to do it all. Because women's challenges are different than men's. And how are you handling self-care, not working through lunch and, looking for your next short-term rental? Well, men have to figure that out too, of course. But we're just coming from a perspective of kind of women supporting each other in a safe place, because it's not always the case, especially in the world of construction and the isms out there. We think those things don't exist anymore, and they do. There's just things that are inappropriately said all the time. And that's going to happen. And that does happen. But you want to create a safe space for women so they can get what they need, get the support, and not do it on their own. Because that's what happens. So many women are investing in life on their own because they're wearing a million hats. So we wanted to create a community that we came together and had a safe place for women. So we do that through a lot of free resources. We have a free community, Facebook. We have meetups. We have 53 meetups across the country and two in Canada. And women come together. And a year later, like anything, Brian, right? You're just like, what's the opportunity to serve women deeper? Because they're asking for things or for more support, I should say. So we created a membership, like an online membership and in-person membership where women are coming together to learn, to be held accountable, to mastermind, to take their investing deeper. And we do that. We open the doors twice a year. So we have about 70 members right now that we're doing a lot of, they're learning, growing, and holding each other accountable too. And that's really neat. And that's really exciting. So we have a lot of different things happening, but that's kind of our core of our business right now, beyond all of our free resources that we're giving.
Can you tell our listeners how they would find out more about you and also the InvestHER community?
We have a free Facebook community on, obviously a free group there, but our website has a lot of like where to go if you're, want to check out if there's a meetup by you or want to learn more about the InvestHER community. So the Real Estate InvestHER, HER.com is probably the best way. You can follow us on Instagram. I do a run with Liz every Monday where I just shoot a video and just kind of share a tip, but that's on Instagram and Facebook. So it's at the Real Estate InvestHER. In terms of like core active projects, because we have a ton of them going on at DeRosa. We have a ton of projects we have, we're actually under contract right now for. So you can kind of learn more about like active real estate work there in terms of projects at DeRosaGroup.com. But those are the two places to find me and what I'm up to.
Can you spell that for us?
Yeah, it's DeRosaGroup.com. And we have a pretty active YouTube channel too. I was on a bunch of videos and actually I just recorded some. So I'm like, I know you haven't seen me in a while, but there's a pretty neat YouTube channel where there's a lot of content for people in terms of investing there.
Thank you so much for having this conversation with us. Very interesting learning about your early experiences after being exposed to Rich Dad, Poor Dad, and trying the different techniques, flipping, rehab, and the duplex and the multifamily, and how that was where you were seeing the best yield. And you started growing that portfolio, bringing in private money, talking, I appreciate you talking us through the syndication process and also sharing information on your InvestHER community. So thank you very much for having this conversation with us. It's been a pleasure.
Brian, thank you so much for having me. It's been great. And thanks for your time too.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group. And you can find out more about me by going to higinvestor.com. That's HIGinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management.
Now offering a $250 per unit project allowance to new clients in West Michigan. Find out more at livegreenlocal.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.